Well, good afternoon, everybody. Welcome to the Georgetown Global Virtual FinTech Seminar Series. My name is Alberto Rossi. I'm an associate professor of finance at Georgetown and associate director of the Georgetown Center for Financial Markets and Policy. Today, the center, in conjunction with the Ripple University Blockchain Research Initiative, is delighted to bring together scholars to present their machine learning related research. We have three fantastic papers. We're going to start with AlphaPortfolio for Investment Economically Interpretable AI, presented by Will Song. We're then going to move over to Forest Through the Trees, Building Cross Sections of Stock Returns, presented by Svetlana Bryzgalova. And then we're going to finish with Leah Stern presenting Selecting Directors Using Machine Learning. So the speakers will have 20 to 25 minutes to present the research, and it will be not interrupted. We will have then 5 to 10 minutes for questions at the end of the presentation. Please raise your hand or use the chat feature to ask questions. I'll be the person handling the Q&A. And before getting started, let me just thank Anna Kormis and Rina Agarwal and John Jacobs for making the event possible. And now I'll turn over the baton to Will Song, who's be the first presenter. He's going to be presenting the paper AlphaPortfolio for Investment and Economically Interpretable AI. Will, you have 20 to 25 minutes.
Thank you, Alberto. It's a great honor to be here. I'm just going to share my screen here. Let's see if that works. Okay, now you should see the full screen here. Okay, well, great honor to be here. Today I'm going to talk about my joint work with Ke Tang from Tsinghua University and Jingyuan Wang and Yang Zhang from Beihang University. Jingyuan and Yang are actually from computer science department, so this is very much a interdisciplinary piece of research. The title of our paper is AlphaPortfolio for Investment and Economically Interpretable AI. Even though it sounds quite trendy, but what we look at is a age-old classical problem in financial economics, that is portfolio management. What we do know is traditional portfolio management approach involves two steps. The first step is about estimating the distribution of moments of return distribution. And the second step is either we take the Markowitz path of mean variance optimization, or in practice, many traders do characteristic sort based on some estimates, and then do I would call a little bit ad hoc weighing, either equal weighted or value weighted, so on and so forth. But we do know due to the lack of long time series, from Merton 1980 onwards, and also the fact that we just don't have many long tail events, return is hard to estimate. Variance, covariance matrices are usually not very stable or invertible. There are many traditional fixes to the problem, but even those achieve very moderate success just because of the nature of the problem. What we want to take here is really a different approach. We want to directly optimize the portfolio. So by definition, it's not going to be a general equilibrium model. It's not going to give you the pricing kernel and all that. But the goal is to achieve a portfolio performance. And we are not the first one to do this. Well, there are several studies by Brand and co-authors who have looked at the issue before. They want to get to the optimal weights of assets in the portfolio directly, either through a non-parametric approach or parametric approach. But the parametric approach is still prone to misspecification, and non-parametric approach is limited in the sense that the model can only reliably implement non-parametric estimators up to 2 predictors in their earlier work. So we want to take a data-driven version of that. The underlying assumption is really the relationship between portfolio weights and predictors is less noisy than that between return moments and predictors. And by getting rid of the intermediate step of estimating the moments or return distribution, we are also subject to less misspecification of the intermediate model or return model. Why would this work? Well, think about how we construct a portfolio. If I estimate the first moment, so suppose I'm constructing a long-only portfolio. The first moment of an asset is, suppose I estimate that very accurately, it's really negative. It's not going to be in my portfolio. So rather than using the statistical powers to reduce the pricing errors of this asset, and by introducing or by finding the right kernel to use, we may as well focus on the assets that I'm going to include in the portfolio and really estimate their higher moments better in order to reduce variance of the portfolio, for example. Okay, so this direct approach is going to be a reinforcement learning based. Is essentially dynamic programming. Once we see the model, we'll get a sense of that. So that's one thing we want to do. We didn't do it in the paper, and I probably wouldn't have time to touch on that. There are further extensions which are related to how we can incorporate dynamic learning and dynamic budget constraints that are related to robo-advising. But that's another benefit of using a reinforcement learning approach to the problem. The second kind of line or contribution we want to make is really to illustrate the utility of cutting-edge AI or deep learning models in finance. We know there have been much advance in AI and machine learning and their applications in finance. We can roughly label them under either dimension reduction or semi-parametric or distribution-free approach to the problem. But we are typically still in a two-step approach. The goal there is to estimate the risk premium, find the right pricing kernel. It's not directly optimizing the portfolio performance in that regard. Recently, there are several applications of neural network approach, but it's still within that framework. What we want to do is to take this new approach, and we also don't want to pull statistical packages directly without, tailoring it to our particular application. So if we think about the data generating processes in sciences or engineering are very different from social sciences. In finance, we know the data that we have do share high dimensionality, non-linearity, that science data also face. But at the same time, our signal to noise ratio is really low. And studies have also revealed there are important interaction effects rather than the sparsity problem that computer scientists typically face. In this study, what we want to emphasize in addition is really the kind of the fast dynamics of the data generating process. Our genes, physical laws don't evolve at very high frequency, but policies change all the time. Investors' preferences, risk aversion might evolve over time as well. So historical data in that sense is not really historical data. So we need to teach the model how to learn with new data that's coming in. And that's why we're taking this AI model and build upon it. And we're also facing panel data where we have multiple assets. So, if we look at the machine learning and AI models developed in computer science, it's typically for machine translation, computer vision, it's a single sequence learning. And by sequence learning, it's essentially a neural net version of our traditional time series econometrics. But we face multiple sequence learning, so we have to make adjustment to that. We also want to demonstrate that our findings are robust to economic restrictions, and we want to interpret the model. That's where we want to come in and make a contribution. There are papers in computer science that use reinforcement learning to look at finance problems, but typically the researchers are not focusing on the economic motivations, restrictions, and interpretation of the model. Okay, the second half of the paper is really, now suppose we have this model that works great, this alternative approach to portfolio management that seems to work well. It's a black box. we don't want black box. We want to understand the economics of the model, of our approach. So the second half of the paper is really devoted to developing procedures to interpret, to distill the model, to figure out what are contributing to the model performance if there's outperformance. So this is very much related to interpretable AI in computer science. The difference is over there, studies either use feature importance analysis or construct surrogate models. And we are the first one to take a hybrid. I'll be more specific on what we do here. Basically, we use two approaches. One is polynomial sensitivity analysis. The other one is textual factor analysis. The basic idea is just to project the black box model onto a linear regression model space. We can put in higher order terms, but we can use the feature importance analysis to figure out which features are important, put their higher order terms and interaction terms into a linear framework. The textual factor analysis is projecting the model onto natural language space in hope of looking at the words that correspond to the portfolio selecting certain stocks to take long positions versus short positions. Does that correspond to what the firm is discussing in their disclosure? So hopefully through interpreting the natural language, we can gain some understanding and narrative of the model. Okay, so these are the areas that we hope to add to the literature. With that, I'm just going to start on the model. But one thing I want to emphasize is, our key contribution or our emphasis is really not on the fine-tuning of the parameter, or some people might say, well, your model is so complex. When you have so many degrees of freedom, of course you're going to do better and all that. That's not always true, right? We look at auto sample tests. We need to guard against model selection bias and the like. So that's not where we are adding the most. What we really want to contribute is this approach, this direct optimization approach. And hopefully I can convince you the choice of this particular AI model is very much motivated by what we need to do, right? If we are maximizing, let's say, the Sharpe ratio of investors, supervised learning, traditional regressions are not going to work. There's no right or wrong Sharpe ratio per se, right? But reinforcement learning is very natural. When we get a high Sharpe ratio in the training set, we provide positive feedback to the model so that it's going to explore parameter regions where they might have the highest gain in model performance. And hopefully all these would become less abstract when we come to the model. Okay, so here is what I plan to do. I'll talk about model methodology and show its empirical performance before I touch on economic distillation, the interpretation part. So this is the model. I don't think given the time constraint, we're going to fully comprehend what we are doing here. So let me just break it down into a few steps. The model we use is a transformer. That's the latest sequence learning tool used in machine translation and computer vision, and also self-driving cars. So what do we want to do? We want to use neural networks to represent the assets information. It could be financial ratios, it could be market signals. And in our representation, we know we're facing panel data. Past dependence, history dependence could matter. So that's why we want to use sequence learning. As earlier sequence learning models, such as RNN, suffer from certain technical issues and limitations. So basically, the candidates we have are long short-term memory, and the latest one is transformer. So we do both. In today's presentation, I'll only report what we find with transformer, because that turns out to guard against certain gradient explosion problems that computer scientists have identified better. Okay, so here's what we do. For each asset, if I label it by I, I'm going to look at a certain window of their features, such as book to market ratio, their earnings growth, whatever feature we have in mind that we feel are relevant, we're going to put it there and using XI to represent it. And then we're going to go through this transformer encoder to further compress the information or embed that into a neural network. I have to skip the details. There is the standard neural networks transformations, linear plus the nonlinear parts. But in the end, we basically have a matrix representing the asset I over time, their features represented in a vector space. That's what we get in this R. Okay, so that's that asset alone. What we add to the model, transformer encoder, is really a cross-asset attention network. The idea is, okay, I have representations of a time series of information for the asset. Now, suppose I introduce some parameter matrices, all these W, query, key, and value vectors. So far, there's no economic meaning to it. It's just matrix multiplication. But what I want to do is, okay, I have a really flexible setup where I introduce these matrices. I'm going to have them multiply the time series representation of the assets, and then look at the cross-asset relationship. In machine translation, there is something similar, which is self-attention, basically looking at the earlier sentences of a passage versus the later sentences of a passage, and take their dot product once we represent them using vectors. And I haven't told you why we do that, right? But that's just the operation we introduced for a moment. Because these operations is going to allow us to generate what we call a winner score. And the formula shown here is the self-attention kind of function that we typically use. The goal is to generate some numbers that captures interactions of assets as well as their time series representation. So far, there's no economic meaning to it. It's just representing the information, okay? But, and this is basically what we have for each T stands for transformer encoder that represent the time series. And by doing, putting on top of that, the cross asset attention network, what we're going to generate is a scalar product. That's something we call winner score. Why do I need this winner score? I'm going to rank the assets based on winner score. I'm going to long the top rank ones and short the bottom rank ones. Now, if I just blindly run this, I'm going to perform really badly because there's no economics to it yet. I haven't trained the model. I didn't specify the model based on economic reasonings other than the input features that are relevant, or at least we traditionally believe are relevant for asset returns and portfolio performance. This last step, training the model using reinforcement learning, is very important. So what is reinforcement learning here? It's basically a dynamic programming approach. We acknowledge the world is too complex. We're not going to be able to fully estimate the distribution of asset returns very well. So what we want to do is really like a child learning how to use a remote control. We're going to let the child try some buttons. If they see cartoon channels, maybe not their best or favorite channels, they are going to explore the buttons in that area more until they gradually learn through dynamic interaction with the environment how to operate a remote control. Here is similar. We set up a really flexible model that generates portfolios based on the winner score. It's going to suck at the beginning if I randomly initialize the parameters. But as I train the model, when I get a high Sharpe ratio, let's say Sharpe ratio is my metric for performance, I'm going to give a thumbs up. That's positive feedback. If it performs poorly, I'm going to give a thumbs down. And then the model is going to explore parameter regions that are going to give me high Sharpe ratio, auto sample. Okay, so that's what a reinforcement learning implementation of the model is. The numerical approach for the model to converge is standard from Berto Sutton's reinforcement learning book. So I'm going to skip that part. Now let me just show you some empirical performance of the model. We look at US equities for illustration. Data source very standard. We train the model pre-1990 until the model converges. We test the model from 1990 to 2016. We do allow monthly update of the model, so it's a rolling test. We also look at the subsample post 2001 after many changes in the market microstructure, so on and so forth. The input signals are very similar to what Framberger and co-authors have in their non-parametric approach. Basically, the inputs fall into a few categories: investment, signals, quality signals, value signals, trading frictions. And we also lag it by 12 months. So it's 12 times 51 characteristics. That's our input feature. For the textual part, textual factor analysis, we use firms filings. Okay, so here is a key table from the paper. This is the performance of AlphaPortfolio on the test set. In terms of Sharpe ratio, return, turnover, maximum drawdown, we can see it does pretty well. The Sharpe ratio auto sample is above 2 typically, especially after we exclude the small stocks. Bigger than Q10 means we're excluding the bottom 10% based on market cap. Those are typically illiquid, hard to trade. They turned out to be drivers of many of the earlier anomalies or even earlier machine learning strategies. But AlphaPortfolio is robust to that. Now, if we control for various risk factors, here I list CAPM all the way through Ho-Xie-Zhang four-factor model, the alpha is still very significant. Okay, we also look into where the outperformance is coming from. Here I'm just on the left panel, I'm just comparing it to the Freiberger co-author paper using non-parametric approach. That's one of the best performing machine learning strategies in recent years. And NP stands for non-parametric, AP stands for AlphaPortfolio. You can see NP also performs very well. But then once we take out the smaller stocks, the performance tends to drop quite a bit. AlphaPortfolio is not suffering from that. This is not meant to be a critique to these other papers. These other papers have a different goal. The goal is to figure out what's the right stochastic discount factor we should have. Can we have a low dimensional representation of SDF? Can we estimate risk premium more accurately? That's not our goal. Our goal is to maximize portfolio performance, okay? And the right-hand side is, suppose I use a different model. Suppose I use transformer encoder, but I do it in 2 steps. I estimate asset returns, and then construct portfolio using equal value weighted. It still outperforms many traditional strategies, but we can see reinforcement learning, the dynamic one-step direct optimization is contributing to the outperformance. This is the time trend for Sharpe ratio, the red line here, and the excess alpha over time. It fluctuates. Some anomalies or some signals might be traded away, but overall, it's still statistically and economically significant. The performance is not driven by the particular time period we look at. No particular industry is driving the performance either. It's not coming from short lag of the portfolio. When we include transaction costs, it's still yielding similar performance. Now we can put in a few other economic restrictions, such as excluding the unrated or downgraded stocks because they are hard to trade. They might be going through some corporate events. Avramov and co-authors have a recent paper looking at machine learning strategies, how they might be affected by imposing these economic restrictions. And here we do see the performance drop quite a bit, but still very significant. And the drop is mainly coming from the fact that in the training sample, we didn't really exclude, we didn't train the model excluding downgraded or unrated stocks. Okay, so that's not too surprising to us. This is how the model performs under different market conditions, different sentiment periods. VIX market liquidity is not driven by crisis episodes where we have high sentiment, low liquidity. during regular times, it is giving similar performance. So let me just touch on this economic distillation a little bit, and then I probably have to wrap up. So now the model works, seems. And again, it's not about a specific setup of the model. It's really this approach, reinforcement learning, direct optimization approach. Now, how can we interpret the model? Without a good understanding, we can't rely on it. It's just another paper pulling machine learning packages. That's not what we want. We want to interpret the model. How do we do it? Well, we first figure out important features in the model based on how they contribute to the objective that we're optimizing. And once we have the features, we add their second order term, we add their interaction terms. You can do it for different degrees for the polynomial. Then we go back to a linear model. And if you are unhappy with too many variables, we can do a variable selection. So this is different features, how important they are over time for AlphaPortfolio's performance. Let me tell you what these symbols are. Basically, it turns out that the profit margin is very important. Cash holding, inventory change turns out to be the most important feature. And inventory change squared, that's also an important term. We didn't really capture interaction terms in that regard. There's also rotation patterns. Financial variables and market trading variables tend to rotate in and out over time. And these are things that we can explore further to gain some interpretation. And finally, we also project this onto the firm's filings. When firms take long positions, the firm's filings are typically talking about loss-cutting profitability. And when AlphaPortfolio is taking short positions in the asset, the assets tend to discuss real estate, corporate events, recent mistakes. And I don't have time to go into more detail, but this is a first text-based interpretation of AI and machine learning models that I think offers some promise to develop narratives. It's not going to be causal identification, but it's an initial step towards interpretable AI in social sciences. So that's pretty much what I have. Basically, we want to provide this illustration of the utility of reinforcement learning. It's really a different paradigm compared to supervised versus unsupervised learning. And we have to make sure it's economically motivated by financial data, the nature of the data generating process. And we also want to be able to understand what the model is doing. And for that, we need these procedures for economic distillation. And the procedures are quite extendable. It doesn't have to be portfolio management. Okay, so with that, I'm going to conclude here. What did we do? Well, in terms of economic approach to portfolio management, we take a direct optimization approach, acknowledging the complex environment that we face. And we also illustrate the efficacy of AI and machine learning applications. The key is really to make them tailored for our particular economic application. And finally, we provide this procedure for interpreting AI or machine learning models. This is a interdisciplinary emerging area. I personally find it very exciting. Also working with computer scientists, very different perspectives. So with that, I'm just going to conclude here and happy to take some questions.
Hey, thank you so much, Will. That was a fantastic presentation. We have one question from Karen Pfeffer, or Pfeiffer, I think it's Pfeffer. The question is, I'm curious about the model's heavy reliance on inventory changes. Do you have a good interpretation for that? Is it maybe some kind of orthogonality to the typical factor that makes the performance so good?
Yeah, so that's a great question. I'm happy to go into more detail offline as well. So regarding the inventory changes, inventory change scale by total assets, it turns out to be an anomaly identified in an accounting paper in 2001. It didn't garner too much attention, but there are economic channels where it's related to certain accounting reporting issues that could lead to firms being underpriced or overpriced. So that's one way that we can go deeper to really figure out what's going on economically. But an initial step that we want to do is just to be able to identify them and see which ones are more important.
Okay, I actually have a question related to the application to robo-advising. I know you didn't touch on it, but like, is your idea would be simply that you would imagine kind of individuals setting their preferences and then the algorithm constructing optimal portfolio locations for whatever their preferences are?
Yeah, so there are actually two kind of directions related to what you mentioned. One is, can we use reinforcement learning to figure out their preference? There are reverse reinforcement learning approaches to figure out, based on their dynamic action, to figure out how their preferences are changing and evolving. That's one aspect. The other aspect is really, they might have dynamic budget constraints, right? If I make more return today, I have a bigger opportunity set because shorting, I need to put some capital with the brokerage and all that. So that is something dynamic programming can easily incorporate, whereas the traditional two-step approach is a little bit hard to incorporate. So that's where reinforcement learning could hold some promise for robo-advising. And honestly, we're at the robo-advising 1.0, and you're the expert, so there's a big room for the development in that regard.
Yeah, I think I think you probably have it in your paper where you or maybe I think it's I don't remember, but so I think that, yeah, robot advising is really at the stage of the rotary phone right now, right? So it's still kind of very, very non-sophisticated. In many cases, the applications can be improved dramatically. But yeah, we have a couple of more questions. I'm going to ask you one, and then you can maybe answer the other questions through the chat so that we can move on. So I think Charu Agarwal is asking, is it correct to say that machine learning models helps to select the significant factors from the whole range of possible factors?
Yes and no. Yes, in the sense that it does perform very well. So some features must have played a bigger role in there, but by machine learning packages themselves, it's a almost complete black box. It's really hard to know which one is more important. Occasionally, we can identify, oh, these are the important features, because based on the gradient numerical optimization, they tend to contribute more. But we still don't know, are they contributing in a nonlinear way? Are they contributing in interaction with other features? And I think that space is wide open. Computer scientists are doing some cross-sectional plots just to see how they are contributing. But I think just coming back to what we all understand, linear models, variable selections, is one, seems a reasonable approach in that regard.
Okay, well, thank you so much, Will, for the representation. I think you have more questions coming in, but I think you can take them through the chat. Let's move on to the second presenter, Svetlana.
Thank you.
Yeah, thank you. Svetlana, are you there? I don't think we see you, and I think you're muted. Oh, perfect.
Hello?
Now we can see it and we can hear you.
Perfect.
Yeah, perfect.
Perfect.
Thank you so much, Svetlana. You have 20-25 minutes for the presentation, and you can take it away.
All right. Thank you so much for putting the paper on the program. So this is a joint work with Marcus Belger and Jason Zhu, both from Stanford. And if I'm not mistaken, Marcus is actually with us today. So he can also help with some of the questions that have been asked in the chat, for example, during the talk. Okay. Let's start. Many, if not most, empirical applications in asset pricing have essentially two ingredients. There are test assets, which are usually a set of portfolios, and then there is the model that tries to explain why their expected returns are different from each other. Over the years, we have largely been focusing on the model side. In particular, we found a lot of new factors and built hundreds of nonlinear structural models. However, there was surprisingly little attention to the left-hand side of this equation. But the outcome of the test is essentially going to be only as accurate as informative is the data that is used for it. And so many factors themselves are also built from exactly the same sorting-based portfolios that are being used as the test assets. But why is that the case? Maybe all these years we have been focusing on the wrong object to begin with. So this is essentially was the start of our paper. And in this work, we are trying to build a cross-section of portfolios that efficiently reflects the information contained in a given set of characteristics. In other words, we project SDF on the characteristic space and find a small number of interpretable base assets that really represent it well. How do we construct these base assets? Our portfolios are going to be based from the conditional portfolio splits. So we call them AP trees because they come from the decision trees, with characteristics driving the construction of a particular test asset. Then we use an economically motivated procedure to prune them, that is to select a small set of potentially overlapping portfolios based on different splits and their depths. The outcome of this procedure is a cross-section of test assets that are easy to interpret. That is, we're going to know exactly what kind of stocks go inside each portfolio at every point of time and why they end up there. This approach allows us to study the impact of nonlinearities and interactions without having to formally model them, and it massively alleviates the curse of dimensionality. For example, I will show you a cross-section of 20 or 30 base assets, which are going to be reflecting 10 characteristics at the same time. Yet, despite having only 20 or 30 portfolios, this cross-section is going to be several times more informative than stacking 100 individual deciles sorted together in one giant cross-section. Our test assets have high out-of-sample Sharpe ratios and alphas, on average 30% higher, and the more characteristics are involved, the better they're going to behave relative to the alternative. They're not spanned by the usual long-shot factors, and obviously pose a much higher bar for existing models. Finally, you can easily customize the procedure to include various constraints, for example, on liquidity, number of portfolios, and the rest. So, one thing that often kind of emerges is the question is, why do we still use portfolios? Let's say, why not individual stocks? Unlike individual stocks, for example, our test assets are going to be balanced. They're going to be relatively stable in their risk exposure, so you could easily use them with structural models and GMM. If you want to get a small test of portfolios, test assets that reflects only some characteristics but not all, you can easily do that. If you want to have a smaller or larger number of portfolios because you're estimating a smaller or larger type of model with larger number of parameters, for example, again, you can easily do that. That is going to be part of our setting. Unlike latent factor models, or for example, different SDFs that are directly based on reflecting characteristics, our portfolios are going to be fully interpretable. And they're going to be easy to use with both tradable and non-tradable factors, either reduced form or structural nonlinear models. So basically, it's a kind of a general solution to the problem. Now, in the interest of time, I'm going to skip the literature review. And one of the reasons is because there have been, of course, a large number of effort from people, both from traditional empirical asset pricing literature and more recently machine learning approach that try to use efficiently the information contained in either macro data or stock-specific characteristics to figure out what is the data generating process that describes financial returns. However, we are going to be looking directly at one question that we think has been largely overlooked in the previous papers, which is exactly the cross-section of portfolios, the selection of the base assets. So what have people largely been doing up until now? People have been using sorting. And here is an example of a cross-section consisting of 16 double-sorted portfolios based on size and value. Just so that we're all on the same page, I'm going to explain how it is constructed. We first sort all the stocks into 4 equally spaced groups based on their size. And here you can see bottom and top 25% of the stocks. In a similar way, we can sort them based by book to market or value. So the intersection of these assets then is going to form 16 double sorted portfolios. However, it is also immediately clear why this approach leaves much to be desired. There is a massive curse of dimensionality. With 3 characteristics, you're essentially already going to be running out of stocks. Why did we use 4 splits, resulting in 16 portfolios with 2 characteristics? Why not 25 or 50 or 75 or whatever is your favorite number? Why they have to be equally spaced? Maybe we should keep everything in the middle as, for example, one big asset, let's call it more or less market, and then add some splits in particular tastes. After all, we do know that most of the anomalies are concentrated towards the end of the cross-sectional distribution of stocks. How to efficiently reflect the impact of nonlinearities and interactions among these characteristics. So all of these issues led us to rethink existing approach. And while our solution, of course, will have its limitations, we hope that it's definitely going to start the much needed discussion. A simple generalization we propose in this paper relies on decision trees or conditional sorts, conditional splits to form portfolios. Here is an example of one such tree. It starts with all the stocks being divided 50-50 into two big groups based on size. And then each of these portfolios could be sorted, say by value, and then, for example, by size again. As a result, we get a tree of depth 3 based on two characteristics. By nature of these conditional splits, we will never end up with empty portfolios. Focusing on the conditional splits here is also important because it allows us to look at the joint distribution of characteristics and study its full impact on stocks, which is actually crucial because of two fundamental reasons. First, most characteristics are dependent, and this dependency structure is not linear and is often hard to capture by, for example, just correlation alone. Conditional splits implicitly take it into account and create balanced buckets of securities. Since characteristics are generally dependent, the order of the splits will matter as well. For example, the left panel shows you the average firm distribution in terms of market cap and book to market ratio, so size and value. And just looking at it, it is immediately clear that if I first sort by size and then by value, or by value and then by size, it will give me very different portfolios. And this is actually true for almost all of the variables we have looked at, almost all of the firm-specific characteristics. And this also matters because the characteristics have a very rich conditional impact on asset returns. Here is a textbook example of, again, size and value. Obviously, an average high book-to-market firm tends to have a higher rate of return than its growth counterpart, which is the purple line on the graph. However, this effect is almost absent in large caps, and it is particularly strong in the small caps. There are many other examples where once some form of conditioning is taken into account, for example, based on accruals or asset turnover, the effect is going to change in magnitude, shape, or even sign compared to its unconditional counterpart. So it's really important to understand these type of complicated interactions as well. So let us consider our favorite cross-section based on size and value, which is probably the most popular set of test assets used in the empirical literature. How would the tree-based portfolios look like in that case? It will probably look something like this, where depending on the firm distribution and their effect, you could have more granular splits in some areas rather than others. And I suspect that some of you are smiling at the moment, both because they actually recognize this picture. They have seen me actually making this joke at, for example, Cavalcade or some other conference, because what you're looking at is the painting from the Museum of Modern Art in New York. But the reality is actually not that far from what you see on this painting. On the right panel, you see the familiar 16 double sorted portfolios based on size and value in the space of cross-sectional quantiles, so going from 0 to 1. On the left, I'm plotting all the portfolios that could be created with trees, both final and intermediate nodes. I'm limiting their depth so that each of them includes no less than 1/16 of all the stocks, so they could be on equal footing with what we get with double sorts. Note how really interesting and complex could be the return generating process captured by the portfolios on the left and how much we could be missing with the usual sorts, which are shown on the right. You will also know that I have, for example, relatively few splits in some areas of this picture, in particular in the southwest corner. And this is because there are simply very few stocks that allow on both size and value. And so the trees endogenously take that into account. This is something which is well known for practitioners, for example, mutual fund managers, because there is almost no mutual funds that are actually holding the bottom 20% of the stocks sorted by value. They are simply too small. Of course, using all the final and intermediate nodes from all the possible trees with a fixed depth is not really feasible for empirical analysis. There are simply too many possible portfolios. So we need to find a way to select those which are really key, those basis assets. And this is the process we refer to as pruning. How does pruning usually works? In a standard application of decision trees or random forest, people tend to use the bottom-up approach. So for example, consider the set of these 3 nodes. So usually one could try to compare, let's say, the return on the bottom 2 portfolios, and if they're different enough, you keep them separate, you do the split. If not, you merge them into the parent node. But this approach is clearly not going to work for our setting. Because remember, our goal is to select blocks for the SDF, the best set of basis assets. That means that together, they should contain as much information as possible that should then form an SDF with the highest Sharpe ratio. If I want to use portfolio logic to this process of pruning or selecting the portfolios, the question at hand is whether I assign the same weight or not to these 2 child nodes in my overall asset allocation. And clearly, the answer to that question depends not only on returns, but also on variances and covariances of these portfolios, not only between each other, but also with all the other assets that I have at my disposal. And this implies that pruning based on some one-dimensional local characteristic cannot really be done here. Choosing the right set of portfolios that really span and form the SDF is a global optimization problem. And this is why usual techniques from random forest and decision trees are going to be really good, let's say, for just return prediction, but they're probably not the right tool if you want to understand the building blocks for the SDF. We have to solve a global optimization problem. But as with any global optimization problem with a really large set of variables, of course, it is going to benefit immensely from different way of shrinkage. So we take all the final and intermediate nodes from all the possible trees with a given depth and construct an efficient portfolio frontier. You will notice that there are essentially 3 tuning parameters here. There is the target return to my portfolio. There is the lasso shrinkage bit lambda 1, and then that can be used to control how many portfolios we want to end up with. For example, select 10, 20, or 50. And then there is the reach part, that's the lambda 2. So that is needed to stabilize the variance and portfolio weights within the overall SDF. As a result, we can select the best robust set of basis assets from both the final and intermediate nodes. That is kind of very narrow, less diversified, and very wide, more diversified portfolios that form the SDF. And this is another aspect in which we differ from the standard pruning of the trees. In the end, we're going to retain only particular nodes colored in red in this picture, not all the portfolios along the whole tree path. In the paper, we studied the properties of this procedure. And in particular, we can show that one can think of this optimization as actually building a robust mean variance portfolio from the point of view of an investor who is very ambiguity averse. That is, it simply doesn't trust the numbers from the in-sample parameter estimates due to their instability and would really like to protect herself against the worst possible case within a certain range of parameters. And it turns out that the optimal portfolio allocation under this estimation uncertainty and Sharpe ratio, expected returns, and their variances is actually going to coincide with our problem 1-to-1. While the lasso and reach penalties are well known in the finance literature, and in particular due to the recent work by, for example, Serhii Kozak and Victor de Miguel, whose papers also have been cited actually by the previous speaker, it is the use of the target return as a tuning parameter that I would really like to comment on. When you vary the target rate of return for your portfolio, what you're really doing is moving along the portfolio frontier between the tangency portfolio and the minimum variance one. In other words, you're going to be shrinking expected returns towards their cross-sectional mean. Why is this important? This is important because there is massive estimation error in expected returns. When you consider a set of 25 or 50 portfolios and choose how much to invest in each of them, it's very likely that the asset with the highest rate of return in sample actually got there simply by chance, just because it's the best out of 50. So if you were to use this usual in-sample estimate, you would overweight it relative to its fair value. And this is where shrinkage to the cross-sectional mean really helps. Of course, the optimal degree of it is going to depend on a particular set of assets. And one sample analog of this procedure is very well known to all of you, I'm sure. This is the so-called adjusted betas, which are published by Bloomberg, because they're also being shrunk towards their cross-sectional average, which is 1. And you can see for almost all of the tradable securities like stocks, where they have the actual estimated beta coming from the data and the adjusted one, which applies shrinkage to the mean. And here is a final illustration of how pruning could work empirically. So instead of splitting all the stocks into, let's say, 8 equally distanced portfolios, you could actually end up with just 5 as a result of this pruning procedure, with one of them being the market, the second including half of all the stocks, or maybe a quarter, and then maybe only one of them going really into the tail, into 1/8 of the stocks. So you could end up with portfolios actually more diversified than the standard sorts to begin with. And it really all depends on the data. The selection between both final and intermediate nodes allows us to understand how granular one should actually go with these splits in the portfolio. Now, let's look at some of the empirics. Our data is going to be standard. So we're looking at monthly returns and some of the most famous characteristics used in the previous literature. And in particular, I'm going to take a list of 10 characteristics. Why? Because these are the characteristics that have been used to construct portfolios available from Ken French website. So those that everybody essentially is using in academic research. The standard application and familiarity would also help us to establish natural basis for comparison. We are going to be focused on the properties of 36 cross-sections. So each of them is going to be based on using size and 2 other characteristics. Why do we always include size? Again, because this is exactly how portfolios are constructed, those available from Ken French website. So again, this is a natural benchmark for comparison. We will use the same portfolio approach to different assets. So all of the results that you're going to see, all of these different properties of cross-sections based on double or triple sorting versus trees or conditional sorts, all of them are going to be coming really from trees versus standard sorting based approach. So it is important to know that all of our empirics is going to be done out of sample. We're going to use the first 20 years of data to estimate model parameters. We're going to use the next 10 years to find the optimal tuning parameters, such as the degree of, for example, shrinkage for each of the cross-section. So they're going to be cross-section specific. And then we fix that selection, portfolio weights, and just let the data speak, let the model run for the next 23 years. All of our portfolios are going to be value-weighted. And we specifically are going to exclude extreme sorted portfolios. So for example, whenever you're using the same characteristics 4 times. In fact, our results would have been even better if we were to use them in our analysis, but we just wanted to be completely fair with the triple sorts and double sorts, because it is impossible to achieve that degree of granularity using triple sorted portfolios. And so we wanted to kind of have these 2 methods to be completely on equal footing. So actually, if you relax this condition, you would see that trees perform even better. On the triple sorted sides, we're going to be using the cross-sections of 32 or 64 triple sorted portfolios, which correspond to using either 1 or 2 cuts based on size. Okay, so here are the monthly out of sample Sharpe ratios that could be achieved by combining an optimal set of tree-based portfolios together relative to that of triple sorts. For the sake of comparison, we are here retaining 40 tree-based portfolios for each of the cross-section. And I will comment on this choice a little bit later. In this graph, I'm sorting all the cross-sections by the Sharpe ratio that is achieved with the trees. And it is clearly much higher than the alternative. But Sharpe ratio could, of course, come from either high loadings on some sources of risk, which come with a reward, or it could come from actually alphas, something which is not spanned by traditional risk factors. And as we show in the paper, to a large extent, they're actually coming from the alphas. These SDF alphas, again, specific to each of the cross-sections, are not spanned by Fama-French 3 or 5 factor models. It doesn't help if you use cross-section specific factors, So illustrated by this picture where, for example, you always include momentum factor whenever momentum has been used as one of the characteristics to construct strategies and portfolios. Nor it changes if we're actually going to include all 10 long-short factors in addition to the market to try to explain the performance of the strategies. Naturally, conventional models also going to have a hard time pricing these portfolios within each of these cross-sections. While conventional cross-section specific long-short factors have no problem achieving an R-square of something like 85 or 90% on triple sorts, even 64 portfolios of triple sorts, their ability to explain our base assets is going to be much worse. And in some cases, you can get only as much as 40% of the R-square. So to be honest, triple sorted portfolios, again, even as many as 64, are actually quite easy to price. Let's look at a particular cross-section to get a better sense of what is going on. Here are portfolios sorted by size, investment, and operating profitability. And in this particular case, there are almost no need to use reach. There are also some moderate shrinkage towards the cross-sectional mean. It was just like 15%. So the left panel is going to show you the Sharpe ratio as a function of the portfolio numbers, those that we retain from the whole set of trees, which is then used to select the optimal value, right? And before, we just set the equal to 40 for almost all of the cross sections. But as you can see, actually almost all of the information is contained in just 10 portfolios. So if you use just 10 basis assets, that's already enough to get like 90% of alphas and Sharpe ratios and everything else. And this turns out to be a very stable result across all of the cross sections. We see essentially the same picture out of sample for almost all of them. This feature of the data is extremely robust. You don't need a lot of portfolios to reflect data well. What you need is to just choose the right ones. And here are some of the summary statistics where I'm highlighting the properties of the cross-section based on 10 tree-based portfolios. As you can see, they have higher Sharpe ratio, not massively, but then again, it's just a representative example. They have more pronounced alphas, and they have really low cross-sectional R-square compared to triple sorts. Your factors, it's very easy to get an R-square of 90%. A much better measure would be looking at the Sharpe ratio, which is achievable out of sample, or how much the data is actually spanned by your factors, kind of like an out-of-sample GRS, which is exactly what we do here. We don't think that our results are driven by microcaps. We have done the same analysis by cutting out different types of data to kind of safeguard against this, which is, by the way, again, very easy to do when you're working with trees. So for example, panel B shows you what happens if we include only stocks with a market cap above 0.01% that of the market. Just to give you a kind of as a side comment, right now there are only about 600 stocks that are going to satisfy this requirement. So these are really, really large caps. This is almost just S&P 500. And we still get high Sharpe ratios, significant alphas, and lower fit from the standard models. In a paper, we also did a bunch of other robustness checks, experimenting with various cutoffs, rebalancing frequencies. We looked at the time variation. Base asset selection is always very stable, even though the weights within the SDF could, for example, change over time, depending on expected returns and volatilities. And the last picture that I really want to show you is essentially the structure of the SDF in the portfolio and the characteristic space. While some of these patterns are going to be similar across trees and triple sorts, others are going to be very different. For example, the whole set of stocks with high investment are going to be basically endogenously treated as one big portfolio. And you should be buying not just small caps, but actually large ones as well. And it really feels like this picture kind of illustrates the strengths of our approach. Information contained in the conditional distribution of firms and the characteristic impact matters for decision making because it affects both kind of the return aspect, but the risk, the volatility aspect as well. And I think at this point, we're only starting to understand how that translates to risk loadings and returns. But triple sorts for sure are just two cores for addressing this type of problems. Finally, just as a very quick side note, I want to show examples of portfolios which are based on 10 characteristics at the same time. And here at the bottom, you see the green and the blue lines. So these are going to be, for example, various combinations of decile sorted portfolios based on 10 characteristics. So you start with like 100 decile sorted portfolios, which usually is assumed to be a really challenging thing to price. It is not. Out of sample, that type of test assets achieves maybe 30% of the Sharpe ratio that you can actually get if you were to use tree-based portfolios. So using decile sorted portfolios and pricing them is actually quite easy, and you're going to miss out a lot of the information which is contained in the returns. In fact, it is enough to have, again, a small number of assets, but rightfully chosen number of assets in order to get almost all of these results. Okay. I would really like to finish this talk by talking a little bit about the overall role of machine learning in finance. And so recently there have been some people kind of getting skeptical about the potential. And the reason it happens is because there are essentially two types of problems that we are facing. And I think Will also has been talking about them in his previous talk. There is the simple prediction, say returns or risk premia as an unknown function of some variables. And this is where standard machine learning typically really shines. It is designed to work there. However, our ultimate goal in many applications is going to involve prediction output that is then used for other problems, for building portfolios, for finding SDF, for getting accurate estimates of some structural parameters. And what works best for the standalone prediction is not necessarily what's actually going to give you the best answer to all these other questions. And so this is why off-the-shelf statistical tools and machine learning tools sometimes can be quite disappointing. It is very important to keep the economics inside the modern data techniques. And then I think we'll be able to do a lot more in different areas of economics and finance. And there is so much potential in these tools that we're just starting to understand. Okay, thank you.
Thank you so much, Svetlana, for the fantastic presentation. We are a little bit behind, but do we have any question for Svetlana before we move on to Leah? And if questions come up a little bit later, you can always write them in the chat. So there is always that option as well. Going for once, twice. Okay, well then let's move now to Leah, who's going to present the paper Selecting Directors Using Machine Learning. Leah, you have 20 to 25 minutes.
All right. Can you hear me? Everything okay in terms of logistics? Okay, perfect. So thank you very much, Alberto, and all of the organizers for putting together, this machine learning day. This is great, and thank you for inviting us to talk about our paper, our research. So this is joint work with Ijel, Eyal, Chen Houghton, and Mike Weisbach. And Ijel and Mike are actually in the audience today. So they're with us today. So the question of selecting directors is a long-standing question in corporate governance. And so what we're really interested in this paper is understanding the decision-making process that goes into selecting directors. Oops, let me see here. And so we've known since Adam Smith and Berlin Mintz that we can expect this process to be filled with agency issues. And the reason is because CEOs are typically those that are, de facto in charge of the nomination process for directors. And the thing is that CEOs today have just as much control over who gets a seat at the table as they did back then, right? And when I say back then, you can take your pick, 1776 or 1932. It's pretty much the same. So really things have not changed much, right? CEOs are still in charge of that process. What has changed though is technology. And so what we do in this paper is we're going to use the predictive power of machine learning techniques to help make some progress in this central area in corporate governance. Okay, so visually, here's what we do. Okay, so suppose that this is the current board and the company, so the firm has a board seat, an empty seat to be filled here. And what we're going to do in the paper, so to visualize what we do, is we're going to employ supervised machine learning algorithms to generate predictions for us for how potential directors would perform on this specific board for this company. So we're going to be taking into account who's currently sitting on the board and what kind of company it is. And the idea is going to be to compare the director that was in the end, that was eventually selected by the board and by the CEO, right, to the directors that the algorithm would have recommended for this board position. And by the way, those faces are actually not real. They were AI generated, so I can use them in my slides. Okay, so this is the idea of the paper. So why do we use machine learning in this paper? So what's the point? So the reason we use machine learning is we think that the problem of hiring directors is essentially a prediction problem, right? So boards have to make some kind of prediction for how they think a particular candidate is again going to perform. And machine learning techniques are simply superior to traditional econometrics when it comes to predictions, to data sample predictions. And there are a number of reasons for this. You know, the big one is that they're designed to maximize data sample predictive accuracy by avoiding overfitting, for example, and by not being constrained by a specific parametric assumptions or functional form, or by being restrained in the number of covariates that they can use. Okay. And so the reason why we really want accurate predictions in our exercise is because we want to use those predictions. So the prediction is not the end exercise here. We want to use those predictions because we want to use them to compare the performance of algorithm versus management selected directors. And we think that this is going to allow us to have something to say about the quality of director hiring decisions. And we can also use those predictions to look not at the performance, but at the attributes of algorithm versus management selected directors. And that's going to speak to the features that are overrated or underrated in the process for selecting directors. Okay, so what do we mean by director performance? So in any algorithm design, a really key component, what's really crucial, is the choice of the label. This is absolutely crucial. So what are you asking your algorithm to predict? And so this is something we've really given a lot of thought, and it's actually not simple. And the reason why it's not simple is because the board acts behind closed door, and the only thing that we observe is the collective action, right? So the board acts as a group. It makes those really important decisions, such as hiring or firing the CEO or approving a merger bid, but we only observe the outcome as a group. But what we really need is an individual measure of performance. And so to guide us in our search for a good measure, a good metric to measure director performance, we go back to the mandate of the board. And we share the view in Hart and Zingales that directors' fiduciary duty is actually to represent shareholders' interests. And that means that the decision-making process for hiring a director, well, it should involve some kind of prediction for how he or she is going to fulfill that mandate, right? So we really would like our measure of director performance to be tied to how well she's going to represent shareholders' interests. And so that's why we're going to use the level of shareholder support. It seems to be a really natural metric for director performance when we go back to what the mandate of the board actually is. And that's what we're going to use as our main measure. To be more precise, we're going to use excess votes. So we're going to use total votes or at annual director re-elections, and we're going to subtract the average that other board members who were up for re-election that same year, the average for the board. And so we end up with a market-based individual measure of director performance. And so we know from the literature on director elections that there's typically really no surprise in terms of the outcome of those elections. Directors get re-elected pretty much no matter what. There's no surprise in the outcome. And they typically gather really, really strong support. So I think the average across studies is around 95%, and that's also what we find here. What's interesting is that in the recent literature on director elections, so even though there's no surprise in the outcome, the variation in the total votes does matter. And the variation really does reflect market perceptions of director quality. So, for example, Fisher et al. Find that the level of shareholder support predicts stock price reactions to subsequent CEO turnover. Kai, Gardner, and Wackling find that low support for directors leads to more CEO turnover and more actions to improve corporate governance down the road. And Rina and co-authors find that receiving low support, low shareholder support has really negative consequences for directors. So again, even though there's rarely any surprise in the re-election outcome, the level of support really does contain meaningful information. So our paper is related to that literature. It's also related to the new literature or emerging literature that uses, but is growing quickly, machine learning in econ or finance. And there are a multitude of new papers, and I simply here listed some of what I think are seminal papers. It's also related to the older literature on discretion versus algorithms, which recently received renewed attention because of the advancements in machine learning. So one of the reasons that may not seem obvious for why we really like our measure of performance, so using shareholder votes as our measure of performance, is that it somehow mitigates the concern, the potential concern that the algorithm might act as a bias propagator. So you may have heard, the concern that we hear. You may have read about this in the popular press or in very serious journals, that algorithms may replicate our worst biases as human beings. And this is actually a real concern. So I'm not downplaying the concern, but here our measure of performance kind of helps in that regard, because we have the decision maker and the evaluator who are distinct entities, right? So what we really wouldn't want, for example, is we wouldn't want those who select a candidate also be the ones who stamp their performance as either good or bad, right? So for example, a not so good measure of director performance would be promotions on the board, right? This would be horrible in terms of replicating biases. So here we have the board that includes the CEO, select the directors, generate our right-hand side variables, and then we have shareholders, separate entity, that generate our left-hand side variable. Okay, so in terms of data, we have roughly 25,000 new directors who were appointed over a 15-year period, so between 2000 and 2014. So we have the shareholder support data for these 25,000 directors. We're going to split this data into a training set and a test set. So the training set is going to be comprised of directors appointed in the first 12 years of our sample period, and then the test set is going to use the last 3 years of director appointments. And we split the training and test set this way to avoid fitting a model to predict director performance using directors that are going to be appointed in the future. So we don't want to do that. And so the predictions that we make, are ex ante predictions. So we're being very careful not to give the algorithm any information that the nominating committee would not have at the time of the decision. And so for a vector of inputs, again, we use a bunch of firm, board, and director level characteristics that we give to the algorithm to generate the predictions. And again, our outcome variable, the main label is this excess shareholder support measure. We also do the same exercise using total support, so without subtracting the average for the state of directors, and we find very similar, the same conclusion. We also run some robustness using firm profitability and CARs. Okay. So what we do in this table is we simply report the fraction of new directors. So in our test set, the fraction of new directors that receive much lower support than other directors on the board. And we break it down by characteristic. So overall, this is considering roughly the bottom 10% of new directors. But you can see that it varies quite a bit by some director and board level features. So for example, you have about 11% of new directors who are male that receive this low support, this bad outcome. And that number is 8% for women. And if you go down the table a little bit, you see that for busy directors, it's 14.5%. So 14.5% of new directors who are busy So they sit on 3 or more boards, they receive this really bad outcome, but it's only 9% for directors that are not busy. So this suggests that there are some characteristics that are associated with lower shareholder support. The thing is, it's really hard to know which functional form of which attribute is going to lead to good out-of-sample predictions, right? So the space of correlates that matter is potentially really big, and how to combine them to arrive at strong out-of-sample predictive accuracy is just really not clear. So this is just simply another way to see why we're turning to supervised machine learning in this case, because those techniques are designed to pick up signal and avoid overfitting in order to generate out-of-sample predictions. So again, the algorithm is going to use features about the director, but also about who else is currently on the board, features about the firm. It's going to see all of this and fit the model for appointments between 20 and 2011, and then it's going to generate predictions for how directors appointed between 2012 and 2014 are going to perform. Okay, so results. So here's one way to show the results, and the results that I'm going to show you only use data on our test set. So those are all out-of-sample predictions. So on the x-axis, you've got predicted performance, and on the y-axis, you have actual performance. And so what we would like for any model that tries to make performance predictions, we would want directors predicted to do poorly to, in the end, end up doing much worse than those predicted to do well, right? So we want actual performance to be increasing in predicted performance. And what we find, so we try various algorithms that are widely used in the CS community. We find that for all of those machine learning algorithms, that's the case, right? So directors predicted to do poorly, they do end up doing much worse than those predicted to do well. And we also tried to run an OLS model, kind of like as a benchmark, but it's clear that the OLS model has issues with overfitting. And so out of sample, the predictions are just simply not very good. Now, from a governance perspective, we're really interested in knowing more about, I don't know if you can see my mouse here. We're really interested in knowing more about these directors. So directors at the bottom of the predicted performance distribution. So in the bucket 1 and 2, right? So we want to know more about these directors because those are directors who predictably received low support from shareholders. Before we can do that, though, we need to take a little detour, and this is kind of a technical detour that we need to take to ensure that we can trust these predictions. So what this graph here is telling us is that the algorithms do well and they make good predictions in our test set. However, if ultimately the goal is to show that the algorithm can improve on board's decisions, then this is not sufficient to show that it can predict well on the test set. And the reason why is because we can only observe how well the algorithm does on cases for which we see the actual outcome. So for which we have the labels, but this is not a random set. So if boards rely on unobservables in their hiring decisions, then the distribution of outcomes for hired directors can be very different from the distribution of outcomes for those that were not hired, even if they have exactly the same observable features. So in other words, among those with the same observables, who gets a label and who doesn't is not random. And that's the selective labels problem. So our way around this involves designing a pool of potential candidates for each new board seat. So in our test sets, right? So we're gonna ask who else could they have hired but didn't. And so for directors in our test set, we're going to look at other directors that they could have hired. And so those are gonna be directors who around the same time joined the board of a nearby smaller company. And the reason we designed the candidate pools this way is that we're zooming in on candidates who we know were available to join a board at the time. They signaled, right, by revealed preference that they would have been willing to travel to that location for meetings, and they would have been willing to accept because it typically pays more, it's more prestigious to sit on the board of a larger company. We also run some robust tests around different ways of constructing these candidate pools, and we find similar results. Okay, So for these candidates, we don't observe how they would have done on the board, right? So that's the essence of the selective labels problem. What we do observe is what we call their quasi labels, right? So their performance on the board that they effectively joined. And so we're going to use those quasi labels as an indication for how those plausible candidates would have performed on the board, on the focal board. And so here's an illustration of that quasi-labels procedure. So the first step is we want to rank all hired directors. So again, in our test set, directors that were effectively hired by the focal firms according to their predicted performance. We're going to zoom in at the bottom and say, well, those are candidates that the algorithm would have flagged them and say those are predicted to do poorly. And then for these, we asked, well, who else was available, but they didn't hire. And so we're going to, for each of these, we're going to grab their personal candidate pool and look at all of those candidates and rank those candidates according to their predicted performance on the focal board. We're going to focus on the top, also the promising candidates. And for these promising candidates, we're going to rank them according to their quasi-label. So according to their performance on the board that they effectively joined. And then the question becomes, where does Y? So Y is the actual performance of those directors that were at the bottom here. So directors, the algorithm flagged them as those are likely to do poorly. Where does Y, so their actual performance, sit in that distribution of quasi-labels? And intuitively, if Y ranks high in that distribution, what does that tell us? It tells us that, well, the algorithm, flagged them as potentially poor performers, but when we look around and we see at who else was available and how they did, turns out that those directors actually did pretty well. So whatever observables the board used in making its hiring decision, was used as signal and it was a good call. On the other hand, if Y ranks low in that distribution of quasi-labels, then this is telling us that those directors were identified as directors who would perform poorly, and they indeed turned out to do poorly. So whatever observables the board used was not signal, but it was noise, or it was agency-related issues. And so what we find is that if you look on the right-hand side of this graph, what we find is that using XGBoost, so one of the algorithms that we use, when we look at directors predicted to do poorly, so directors in the first decile of predicted performance, the median rank in the distribution of quasi-labels is the 27th percentile, so pretty low. And directors predicted to do well, they rank at the 78th percentile. And when we contrast that to the performance, so it looks like OLS just has a really hard time in discriminating ex ante who's going to do well and who's not. So in this graph, we see that the rank in the distribution of quasi-labels increases across deciles of predicted performance. And this is when we compare with all potential candidates. And so what this does is it really confirms the validity of the predictions beyond testing performance on the test set and dealing with the selective labels problem. Okay, so now, obviously those quasi-labels are not a perfect substitute for labels, right? So we're very aware that those quasi-labels might be inflated because the match between the board and the director is an endogenous match, right? But from our perspective and for the exercise that we do here, this is simply a noisier benchmark than the ideal benchmark that we like to use. And so what we simply need is we need the distribution of quasi-labels generated by candidates in the pool to approximate the distribution that they would have generated had they served on the focal board. So it's really the distribution that matters. And the second assumption that we need is that the error is not systematically correlated with Y-hat, with predicted performance. And remember also that those candidate pools and the quasi-label procedure, all of this, we only use it to evaluate the predictions from the algorithm in order to deal with the selective labels problem. But in practice, the algorithm can still make a prediction for any director, and boards can still rely on patterns matching. But we really think that this quasi-labels procedure can be used in other prediction contexts in which labels are missing, and kind of as a way to go around that selective labels problem, which is pervasive if we want to apply machine learning in social sciences. Okay. So as I said earlier, from a governance perspective, what we're really interested in is understanding a bit more about those directors that populate the bottom bucket, right? So who are those directors and why were they hired if they were predictably unpopular? For each characteristic here, we're going to show the mean for directors who were hired but were predictably bad, and the mean for directors the algorithm would have recommended instead. And so what we find is that some overrated features in the director selection process is being male, having a large network, having a finance background, and lots of current and previous directorship. And an underrated feature is actually the number of qualifications. Okay. So conclusion. So maybe I should have said this a little bit earlier, but we're currently actively revising the paper, and we have very exciting new results coming soon. So stay tuned. But to wrap up, what we do in this paper is we use 21st century technical tools to confirm an observation that really dates back over 200 years, namely that the board selection process leads to directors who often are not necessarily the best choices to serve shareholders' interests. And we strongly believe that predictive algorithms, such as the one we use in the paper, hold promise for improving board's choices of directors and for improving the way in which governance serves shareholders' interests. So thank you.
Thank you very much, Leah. That's fantastic. Your co-authors already have taken care of some of the questions, but you still have a couple of them. Yes, I think Mike was very, very active. But so we have the first question is from Jikan. I think Mike didn't have the time to kind of answer this question yet, but Jikan is asking, how do you know? Oh, so how do you think about considering industry or sectoral fixed effects? Because it may be possible that increasing trends in EBITDA, for example, may be higher in certain sectors and specific areas.
Right. So we do take that. So the algorithm does see which industry the companies operate. So there is kind of some, it does take industries into account. Also, we do take industries into account when we do that exercise of looking at other potential candidates who could have been hired. We, at some point, we restrict to only candidates, to only other directors who join the board of a company in the same industry, right? And so we do take industry into account. That's absolutely, I think, important, right? Yes.
And I think he has a second question, which is more technical, is what about, can you talk a little bit about the hyperparameters that you set for the XGBoost? Are you taking like the standard settings that the packages have, or do you modify that?
Yeah, so that's a good question. So, so we do use the standard, default parameters in XGBoost, and really, I like this question because the innovation in the paper is really to kind of flip the question of the quality of boards and on its head, right, and pitch this as a prediction problem. And so the innovation is not kind of to come up with absolutely the best algorithm. We're a little bit agnostic about which algorithm does best or should do best. And so in that sense, we're not trying to, we just say, okay, let's try XGBoost, which is a very powerful algorithm, and then in terms of the hyperparameter, we tried with the default, and it works really well. And so we're not kind of trying, but so that also goes back to the idea that we're trying to, the way we view this paper is really as a first pass exercise to kind of show that there are directors who we can predict that they're not going to do so well. And but again, I'm sure they could be better at, if you had better data, so privately obtained data, and if you had a better algorithm, you could make even better predictions, right? That for sure. Yeah.
Mm. And I think on the flip side, and this is kind of more of curiosity I have. So when you use OLS, do you use just a kitchen sink OLS? Do you put all the regressors in, or do you do model selection? Because in many cases, whenever you start using model selection criteria like AIC or BIC, you start seeing that even OLS performs reasonably well in this kind of exercises.
We tried different OLS models, you know, and it kind of didn't really matter which one. It's just it did well in sample, but out of sample did not do so well. But again, like I think if OLS had worked well, then that would have, it again goes back to what is the innovation of the paper. Is like, if OLS had done well, it's still this predictive exercise, right? And so but it really did turn out that whatever we tried with OLS, it didn't do well out of sample. It really could not discriminate exactly who's going to end up at the top and who's going to end up at the bottom. And when we considered that quasi-labels procedure, it's horrible.
Okay, perfect. Thank you so much. We are right on time. It's 1:30. Let me give another couple of seconds in case someone else has any other questions. And otherwise, let me just take this opportunity to thank very much the presenters. They all did an amazing job. Thank you, Svetlana, Will, and Leah. Once again, we have a number of initiatives here at the center, so please make sure to check our website and follow us on Twitter at GUFinPolicy. And so just a reminder, we will not have an event next Friday, mainly because MBR is having this household finance sessions that are going to be covering a lot of aspects related to fintech. So the next event will be on July the 24th. So you'll receive an email with all the details over the next couple of weeks. Thank you so much for logging in and have a wonderful weekend. And thank you guys. That was awesome.